Welcome to the Deep Dive. Today we're exploring a really fascinating area where technology is unlocking some serious value.
Yeah, especially for complex organizations like, financial institutions, banks, insurance companies.
That's right. We're talking about something called location intelligence.
It's a capability that's, well, it's quietly transforming how decisions get made across the industry. It's quite powerful.
So our mission for this deep dive is to really get under the hood of location intelligence, specifically in finance,
hmm
not just, putting pins on a map, but how it's actively creating tangible value across different parts of these businesses.
Right. So, at its core, what is location intelligence? It's basically about getting meaningful insights from anything tied to a place.
Okay, like what kind of things?
Well, think maps, obviously, addresses, property information, population density, movement patterns, even how things cluster together geographically.
Got it. And the real power, especially for finance, comes when you combine that geospatial stuff with the bank's own internal data.
Exactly. That's the key. Layering it with transaction histories, customer profiles, risk scores, loan books, all that business data.
Suddenly you're seeing everything through a completely different lens,
Uh-huh.
a geographic one.
Precisely. And you have to remember financial services operate under, well, intense pressure. Competition is fierce, and managing risk effectively is absolutely critical.
Non-negotiable, really.
Totally. So, understanding the where of their business, the geographic context, is becoming essential. It's a powerful layer of understanding that, frankly, wasn't fully utilized for a long
It
time.
was more than just basic mapping, but they weren't quite digging deep enough.
Yeah, it's like they had all this location data, but weren't really mining it for the deeper patterns, the hidden connections.
Okay, so that brings us to the core question.
Yeah.
Where is location intelligence really adding value right now in finance?
Well, one of the biggest areas, and maybe the most critical, is enhancing risk assessment.
That makes sense. So using location for more sophisticated risk mapping, right?
Absolutely. You can take hazard data, think flood zones, wildfire risk areas, hurricane paths, and layer that directly onto your property data or your loan portfolio.
So you can immediately see where you have concentrated physical risk.
Exactly. But it's not just about natural disasters, though that's huge. You can also overlay things like crime statistics, local economic indicators, demographic shifts.
To pinpoint areas that might pose a higher credit risk or maybe insurance risk.
Precisely. It allows for a much more granular, much more geographically specific view of potential exposure. You're looking beyond just the individual customer's profile.
You're adding the risk profile of the place itself.
That's it. Crucial context. And it's not just static risk either. Location is proving incredibly valuable for fraud detection, too.
Ah, okay, I can see that. Spotting weird geographic patterns in transactions.
You got it. Like detecting two transactions happening almost at the same time, but in locations that are physically impossible to travel between in that time frame.
Classic fraud indicator.
Ah,
Very classic one, yeah. And location data flags it instantly. There was an example with U.S. Bank using mobile location data comparing where the customer's phone generally is versus where a suspicious transaction just happened.
that kind of real-time geographic mismatch, big red flag.
Huge red flag, yeah.
Okay, that makes total sense for risk. Now, shifting gears a bit, but still crucial, optimizing the physical footprint. Branches, ATMs.
Right. Even though everything's going digital, that physical presence is still vital for many customers and many services. Location intelligence is essential there.
So how does it go beyond just, finding a busy corner for a new branch?
Well, it's about layering data again. You're looking at really detailed local demographics, income, age, maybe even cultural factors. You combine that with foot traffic data, commuter patterns.
And competitor locations, I assume.
Oh, absolutely. Where are the competitors? How are they performing? Banks like JP Morgan Chase,
Mm.
TD Bank, they use this kind of deep analysis for strategic site selection. Is this the right spot? Is it serving the right market? How does it stack up against the competition nearby? And that analysis must directly feed into making sure branches and ATMs are actually convenient for the people they want to reach. Customer accessibility.
Exactly. Making sure locations are genuinely convenient for your target customers has a direct impact on, satisfaction and loyalty. TD Bank, for instance, uses location analysis to optimize its ATM network.
Placing machines based on where people actually are and need cash.
Precisely. Based on detailed analysis of footfall, withdrawal patterns, making sure they're efficient and available right where customers need them most. It's about aligning those physical assets with actual observed customer behavior.
Which leads us nicely into the next big value add. Using location intelligence to transform customer engagement. More personalized marketing, better experiences.
Yeah, this is where understanding that local context really shines. You can tailor marketing campaigns much more effectively.
How so?
Well, based on the specific needs and characteristics of the population in different geographic areas.
So maybe targeting retirement planning services to neighborhoods with more older adults versus, say, first-time homebuyer mortgages in areas with younger families.
Exactly that. You can create these really specific micro market segments. It's based not just on demographics, but maybe local behaviors too. I think City piloted something using beacons and geofencing.
Oh, yeah?
Yeah, to send targeted messages to customers if they were, say, near a sponsored event, or exploring offers based on their immediate proximity.
So using location to deliver hyper-relevant info or offers right when and where a customer might actually find it useful.
That's the idea. And just understanding local trends helps in other ways too, like tailoring branch services or even staffing levels to match what's needed in that specific community.
Right.
One bank found that using location insights to inform personalized financial advice, maybe advice tied to local real estate trends or business conditions nearby, significantly boosted customer satisfaction.
That makes sense.
Hmm.
So beyond the individual customer, this level of geographic insight must also give institutions a real competitive advantage overall.
Oh, definitely. Market analysis powered by location intelligence is, well, it's critical now. You can map out exactly where your competitors are, analyze their strengths and weaknesses in specific areas.
And maybe spot gaps,
Yeah.
underserved markets.
Exactly. Identify those opportunities. And then you can differentiate yourself by offering unique services or products specifically designed to fill those local needs you've identified.
So using location data to find a niche.
Right. We saw an example where a financial institution analyzed competitor locations, found gaps in service offerings in certain neighborhoods, and introduced niche products just for those areas. Gave them a real edge.
And these kinds of location-based insights are becoming so valuable that companies are even finding ways to, well, monetize them.
Yes, that's happening too. MasterCard partnered with Cardo, a geospatial platform, to offer businesses anonymized, aggregated insights on consumer spending patterns based on location.
Not tracking individuals, though.
No, no, definitely not. It's about macro trends. Like, how does spending change in a retail district after a big new store opens? That kind of aggregate insight is incredibly valuable for all sorts of businesses, including financial institutions trying to understand economic activity.
Understanding the where of commerce is clearly powerful.
Yeah.
Okay, shifting focus again slightly, another really important area is how location intelligence can support more equitable finance, financial inclusion.
Yes, this is a hugely important application. Using spatial analysis, institutions can actually map out areas that have been historically impacted by discriminatory practices, like redlining.
Wow, so using the data to literally see the geographic footprint of historical inequality.
That's exactly it. It helps reveal those geographic patterns of disadvantage, the structural barriers that might still exist, and that understanding is the first step.
So what's the next step? How does it help?
It allows institutions to then identify the specific hyperlocal needs within those underserved neighborhoods, and then they can tailor products and services, maybe specific microloans, financial literacy programs, more accessible banking options to increase access and participation for communities that were historically shut out.
That's powerful.
Well,
I also read that in some parts of the world where traditional credit histories are thin, location data can even help assess credit worthiness.
yes, that's a fascinating development. In regions, say in parts of Africa, India, Latin America, where formal financial records are scarce, location data can sometimes act as a proxy for stability or economic engagement.
How does that work?
Well, fintechs and microfinance institutions might look at geospatial patterns like proximity to established markets, access to infrastructure, maybe even patterns of movement suggesting commercial activity. They use this to build alternative credit scoring models.
Effectively opening doors for people previously considered unbankable by traditional metrics.
Exactly. It's using location intelligence to enable something fundamentally new in terms of access.
Really interesting.
Yeah.
Okay, one final area that's becoming increasingly critical, climate risk and ESG monitoring.
Absolutely crucial, especially for the long term. Banks and insurers are now systematically integrating detailed climate and hazard data into their core decision-making processes.
We're talking flood maps, sea level rise projections, wildfire risk data.
All of that, yeah. Severe weather patterns, too. They're layering this onto their portfolios.
And it's directly impacting lending decisions, insurance pricing.
Precisely. You see major European banks and insurance groups really leading on this. They're using location intelligence to truly understand their exposure to environmental risks, which then informs underwriting, loan pricing. Ultimately, it helps them build more resilient balance sheets for a changing climate.
So location intelligence is enabling financial stability in a whole new environmental context.
You could say that, yeah.
Okay, it's obvious that making all this work relies on, well, a ton of data and some pretty sophisticated tech.
Oh, absolutely. The amount and variety of data is huge. You've got demographic data, mobile location data, often anonymized and aggregated, transaction records, satellite imagery showing land use or property conditions, historical hazard maps, property tax data. The list just goes on.
And crunching all that requires some serious technological muscle.
It really does. You need robust GIS, geographic information systems platforms, and increasingly, AI and machine learning are layered on top to process it all, analyze it, and find those complex patterns hidden within these layered data sets.
The real magic happens when you combine it all, though, doesn't it?
That's the key. No single data set tells the whole story. It's the overlaying, the analyzing of relationships between these diverse data types within that geographic context. That's where you extract the really meaningful, often non-obvious insights.
Thinking about the sheer scale, especially for big banks, integrating all that disparate data must be a massive challenge.
It's a major hurdle, no doubt. Spatial data comes in so many different formats, from countless sources, often not designed to work together. Getting it all cleaned up, aligned, and into a system where it can be analyzed effectively takes significant investment. Infrastructure, yes, but also expertise.
But the payoff can be huge, even for something as basic as just cleaning up customer records.
Yeah.
You mentioned entity resolution.
Yeah, that's a great example. Entity resolution is just figuring out if different records actually refer to the same person or business. Like, is Fred Smith in System A the same as F. Smith in System B?
Tricky just based on names.
Very tricky. But if both records are tied to the exact same address, 10 Smith Street, say that the probability they're the same person just skyrockets.
Right.
The head of location intelligence at RBC mentioned something like 92% of their data has a location component attached. Think about how fundamental getting customer identity right is, and how location is the key to unlocking that accuracy across nearly their entire data landscape.
And then there's just the insane volume of data. RBC processing 800 million transactions a day, just in Canada. You can't possibly store all that forever.
Exactly. It points to a future challenge, but also maybe a necessary shift in approach. Instead of trying to archive absolutely everything, maybe future systems will rely more on real-time or near real-time analysis.
Like scanning the data as it flows.
Sort of, yeah. Think about huge science projects like the Square Kilometer Array telescope. It generates petabytes of data. They don't store it all. They run incredibly sophisticated AI engines across the data stream, looking for specific patterns as the data comes in.
So financial institutions might move towards developing AI scanning agents that are constantly watching live data streams for specific things.
Yeah.
Fraud patterns, risk indicators, maybe emerging customer trends, without needing to store every last byte indefinitely.
That could well be the direction. It shifts the burden from pure storage to intelligent, real-time processing at immense scale. And building on that foundation, another really exciting future possibility is the concept of digital twins.
We hear that term a lot. So in this context, it's like creating a virtual copy of the physical world. A city, maybe?
Yeah, a highly detailed virtual model of a city or a region or even something like a supply chain. But the real power comes when you layer dynamic financial and transactional data onto that virtual world.
Which would let you model really complex scenarios.
Incredibly complex, geographically influenced scenarios. Things like detailed supply chain mapping, understanding exactly how goods and money flow through a specific region.
Okay.
Or, as RBC discussed, maybe tackling really big, complex questions, like modeling the potential impact of, say, changing mortgage interest rates on climate change adaptation efforts in a coastal city.
Whoa. Connecting interest rates to climate impact via location? That sounds ambitious.
It is. It requires modeling very complex systems and understanding all those spatial dependencies. It's definitely an area needing a lot more innovation. And it was noted that places like Canada and the US might actually be a bit behind some other regions in developing these advanced digital twin capabilities for financial modeling. But the potential to analyze these deeply interconnected, geographically rooted issues is there.
And a lot of this future stuff seems to rely heavily on this growing field of GeoAI.
GeoAI, yeah. It's essentially the fusion, the marriage of geospatial data analysis with AI and machine learning techniques. It's what enables the really advanced analytics, the predictive modeling, the automation within these spatial contexts.
Sounds incredibly powerful, but also incredibly complex.
It absolutely is. And one point that always comes up, and it's critical, is data quality.
Mm.
For GeoAI to work effectively, the underlying geospatial data and the business data have to be accurate, consistent, high integrity.
Garbage in, garbage out, basically.
Pretty much. No matter how fancy the AI, if the input data is flawed, the insights will be unreliable.
So ultimately, what we seem to be seeing is this fundamental shift, isn't it? Location isn't just another piece of data anymore. It feels like it's becoming foundational to how businesses understand and operate in the real world.
I think that's exactly right. As one expert put it, location is moving beyond just being a mapping tool. Location 101 to being a fundamental element. Without it, many critical strategic projects, many operational improvements simply can't succeed anymore. It's becoming table stakes for truly understanding the context and dynamics of financial activity.
Looking back over our conversation, it's really clear just how broad the impact is. Location intelligence is adding significant tangible value across the board for financial institutions.
Yeah, from managing risk much more effectively and optimizing physical operations.
To understanding customer behavior on a much deeper level, gaining a competitive edge, even supporting financial inclusion.
And starting to tackle huge challenges like climate risk. It touches so many areas.
Because location isn't just about knowing where something is on a map.
No, it's about understanding the context of that place, the relationships between different places, and how all those spatial dynamics influence financial behavior, risk, and opportunity.
So when you think about where this is all heading, rapid advances in real-time data, more sophisticated AI, maybe even these future digital twins.
All fundamentally powered by location information.
It really leaves you with a thought, doesn't it? How might the financial services you interact with every day, how your risk is assessed, how your insurance is priced, how your bank communicates with you, maybe even its role in bigger global issues, how might all of that become even more tailored, more predictive, perhaps more impactful on the world around us simply based on,
Yeah.
well, based on where you happen to be?